Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.
Well, let's do that. And you mentioned a couple of times in your answer the emerging market, and the IMF in their sort of anxiety bulletins have also been talking about the threat of a potential debt crisis engulfing the emerging markets. As I read it, the concern seems to be primarily with corporate debt. How real is that threat in your view? And if defaults happen on a large scale, will the impact be limited to the emerging markets themselves?
Well, those are great questions, John. First of all, the threat is very real. Let's just put some numbers on it. The whole idea that the world was over leveraged, there's too much debt and too much leverage in 2008, and we had a financial crisis, and tens of trillions of dollars of wealth were destroyed. But we learned our lesson, and we're going to deleverage. That is not true. The world is more highly leveraged today than it was in 2008. There have been over $60 trillion of new debt created since 2008. So the world is actually more leveraged and more dangerous than it was in 2008. So that's the starting place, and that's part of what the IMF is talking about. But specifically, there is $9 trillion of dollar-denominated emerging markets corporate debt. Let me unpack that a little bit. First of all, $9 trillion is a huge number. It's almost 10% of, it's actually slightly more than 10% of global GDP. But this is emerging markets only, so we're not talking about developed countries. We're not talking about Australia or Canada or Europe. These are just emerging markets, primarily the BRICS, a lot of it in China. And it's corporate debt. We're not talking about sovereign debt. Sovereign debt can usually be finessed. I mean, sovereigns can get into trouble, as we've seen in Greece and Ukraine and a few other places. But that's where the IMF is. Where the IMF will bail out a sovereign, but the IMF cannot bail out corporations. The IMF's not around to bail out corporations. What they could do is bail out countries, and the countries can take the money and bail out their own corporations. That's how that works. But so with $9 trillion of dollar-denominated corporate debt in emerging markets, and so the dollar's getting stronger. What does that mean? Well, it means your debt burden's going up. If you're let's say you're a hotel operator or an airline or a manufacturer, any business in Brazil or India or Indonesia or Turkey or any of these or China for that matter, and you borrowed dollars. I mean, why did you borrow dollars? Well, you borrowed dollars because the interest rate was cheap. You're paying kind of 1 or 2, maybe 3% at most on your money, and using it to expand your local operations. But if you're getting paid in yuan or Turkish lira or Indonesian rupiah or Brazilian reais or any of these foreign currencies, if that's how you make your money, but you owe dollars to the bond market or JP Morgan or whoever, and the dollar gets stronger, well, your debt burden just went up. So you're caught between a rock and a hard place. You have a slowing economy, so your revenues in local currency are probably going down, but the value of your debt is going up because the dollar's getting stronger. That's a recipe for default, and we're beginning to see that. Now, then you have to say, well, where do these companies even get the dollars to pay off the dollar debt? Well, they have to go to their central banks. That means you've got to cash in some of your reserves, and we're seeing huge reserve drawdowns. Russia, China, Malaysia, again, all over the world. China, not that long ago, people threw the 4 trillion number around, the $4 trillion of reserves. Well, guess what? That 4 trillion is now down to 3.5 trillion, and the money's coming out at a rate of over $100 billion a month. There are huge capital outflows coming out of China. So a lot of these reserves that have been built up since 1998, the emerging markets were not hurt that badly in the global financial crisis in 2008. I mean, everyone suffered to some extent, but that was very much of a developed market crisis. It was a U.S.-European crisis, more so than the rest of the world. China got through it okay, but part of the reason was that a lot of these emerging markets had been the center of gravity in the 1998 crisis. They had learned their lesson, built up the reserves, were managing their economies better, et cetera. So they got through it in a lot better shape than the U.S. and some others. But here we are almost 10 years later, and they seem to have forgotten those lessons. And so now, as I say, their reserves are draining out very quickly. So yes, there is a potential for crisis in emerging markets debt. That's what it's not just the IMF, but also the BIS, Bank for International Settlements, and Basel, Switzerland have warned about it as well. Now, the second part of your question is, well, if that crisis breaks out, and I think that is likely because I think growth is slowing down. We already talked about growth is probably worse than the IMF forecast. The Fed shows no signs, at least so far, of easing. I mean, a lot of this could be alleviated if the Fed eases. The way the Fed would ease, and I do think they will by early next year, kind of, maybe end of the first quarter, beginning of second quarter next year. Again, people say, well, how can the Fed ease? The interest rates are zero. How do you ease? Well, you ease by words. You ease by going back to forward guidance. You put some words in the statement that tell the markets that you're not going to raise rates anytime soon. Think of the phrases they've had, extended period, considerable time, patient. These are all the buzzwords that the Fed has used to signal the markets that they're not going to raise rates. And by the way, you say, well, what's the significance of these words? I mean, I talked to the guy who writes these statements for the Fed. He said they just kind of make it up, and then what they do is they call John Hilsenrath at the Wall Street Journal, and they tell him what they think they mean. And then Hilsenrath reports it. I mean, he's a good reporter. I'm not criticizing him. He's just doing his job. It's nice to have those kind of sources. So he reports it, and then everyone says, okay, we get it. But, the process of sort of picking words out of a thesaurus, sticking them in a statement, calling the Wall Street Journal to tell everyone what it means, and everyone nodding and saying, okay, we get it. That's how we conduct monetary policy today. So the Fed could go back to easing. That would make the dollar weaker. That would take some of the pressure off this emerging markets debt. That would, give the U.S. economy a break. But then, of course, you're back to the currency wars. You're back to 2011 again with a weaker dollar. Then all the countries that are complaining that the dollar is too strong, causing capital outflows, they would then start to complain that the dollar is too weak, causing them to lose exports. Well, you can't have it both ways, but that is the problem with the currency wars. It's a zero-sum game. They're always losers. All you're doing is picking different sets of losers at different times, but you're not really solving the global problem. So this emerging markets debt crisis is serious. In the intermediate run, I mean, I think by the middle of next year, you may see the U.S. try to weaken the dollar through some Fed easing policy. But right now, today, that's not happening. The Fed continues to talk tough. Markets continue to expect, a rate increase maybe in October or December. I personally don't. I don't have that in my forecast, but a lot of people do. But it's a very, very messed up world. The bigger picture, John, is that there's too much debt, not enough growth. That's simple. Too much debt, not enough growth. There are only three ways out. You have to have inflation to get rid of the debt, or default to get rid of the debt, or you have to have real growth. And real growth requires structural reforms that governments don't seem to be willing to step up to. Inflation, the central banks can't get it because the deflationary forces are too challenging, and nobody wants to talk about the D word, which is default, because that has consequences and spillover effects and could cause a global financial panic. So it's not a great menu of policy choices, but there are no other ways out of this. And if the emerging markets start to melt down, which will happen unless the Fed eases, and my guess is at the end of the day the Fed will ease, but if they don't and that meltdown starts, there's no way it will be contained to the emerging markets. It will come back to affect the U.S. through contagion. And the way that channel works is, hedge funds and banks and other leverage traders who start to lose money in one market and get margin calls because they're leveraged. What do? Well, they sell something else. You can't sell the thing you want. You sell the thing you can. And if you've got U.S. stocks and they seem liquid, even if you like the U.S. stock market, you'll sell the U.S. stocks to get the cash to meet your margin call on your emerging markets bonds that are going into default, where you lever them up with the dealer and the dealer is calling you for margin. So that's how the contagion spreads around. So there's no way it'll be confined to the emerging markets. Which brings up the whole, I'll leave it to you, John, if you want to touch on it, but it brings up the whole subject of liquidity in bond markets.
I would be interested in touching on it. What strikes me is, because we're talking about the IMF, that they're touching on it. It's another of these warning signs coming out of the IMF. They're worried about declining liquidity in the bond markets. It's something you've addressed in these conversations before, and I wonder if you have any new thoughts to share with us on that.
Well, I do, and again, this is one of these papers that has come out of the IMF meeting. If you look at this is Chapter 2 of their Global Financial Stability Report, but it's called Chapter 2, Market Liquidity, Resilient or Fleeting, ? It's 60 pages of pretty densely argued stuff, so not exactly light reading, but here's the bottom line. They say something that's very odd. They say that liquidity is sort of okay, not great, but okay. They don't sound as dour on it as some other analysts do, probably because they don't want to panic people. But then they say it can disappear instantaneously. That's a weird thing to say. And instead of saying it's getting weaker and weaker and weaker, they're saying, no, it's okay, but it could go away in the blink of an eye. That's pretty scary. By the way, we've seen that. We've seen examples of that. We're almost up on the first anniversary of the October 15, 2014 flash crash in the U.S. Treasury market, when that was a funny kind of crash because prices went up, but what went down were interest rates. But that was not the sort of smooth, continuous trading and price level adjustment that the academics always assume. It was what's called a gap move, where prices are, in one instant they're one level, and then they just drop, like 4 standard deviations in the blink of an eye. They just reset at a different level. That's what happened, and we're going to see more of that, where there's a panic, or there's some catalyst, some catalytic event, something causes everyone to get on one side of the boat, and then the boat tips over. So that's what the IMF is warning about. Now, they go on to say, and this is the part that I found intriguing, well, what's the point of giving a warning? And the IMF doesn't run the bond market. They can talk about it all day long, but they're not the U.S. Treasury, or they're not the Exchequer, or the French finance ministry. So they're giving the warning. They can't really do anything about it. But what do they recommend that governments do? They say you ought to take preparatory moves. You ought to basically take preemptive strategies to deal with the fact that liquidity can disappear. Well, what would that be? And as you think about what they're really saying, they're saying you better get ready to lock down the system. Because if liquidity disappears, this is like a run on the bank on steroids, and you can't make it come back, and you can't print any more money because you're at the outer limit of confidence. What can you do? Well, you can close markets. You can freeze bank accounts. You can do what they did in Greece. You can put on capital controls. There are things you can do, but they're all really ugly if you're an investor trying to get her money. So this is one where I do think it helps to not even read between the lines, but at least understand, when the IMF uses words like, they don't say contagion, they say spillover. They don't say lock down the system, they say macroprudential. But when you hear the word macroprudential coming out of the mouths of an elite global financial regulator, you should think to yourself, oh, they're saying I can't get my money. So I think it's an ominous warning, but what's even more ominous is what they're recommending people do about it. They're saying, well, we don't have a magic wand to restore liquidity, and we do think you ought to get ready. So what we're suggesting is that if you're not prepared to print the money or hand it out or guarantee deposits ad infinitum, you better be prepared to close your markets. Well, it's one of the reasons I like gold. One of the great things about physical gold and non-bank storage is that it's not in a bank, it's not in a market, it's not digital, it can't be locked down by executive order. So, again, I've never ever recommended investors go all in on gold, but I've recommended 10% allocation. Some people think more. I do have clients who have 20%, even 50%. I think that's so high, but the truth is the average institutional investor has less than 2%, and a lot of people I talk to have 0%. They listen, they're kind of interested, but at the end of the day, they don't actually make the move. And the bottom line on all that is they're not prepared for what we're talking about. But this is not fantasy. This is not scaremongering. People accuse me of being a scaremonger. I say, I'm not a scaremonger. I'm an analyst. I'm telling you what the IMF is saying. I'm not making things up. I'm telling you what the BIS, the IMF, the G20, the World Bank are saying. What they're saying is that liquidity can disappear in the blink of an eye, and your solution is to basically lock down markets. And if you don't want to be frozen in that situation, then you should have some gold in non-bank storage so you can have access to it, and then that's your liquidity.
Well, thanks, Jim. And now Alex Tanzik is here with questions from our listeners.
Thanks a lot, John. I was just a couple of minutes ago just pondering these things that Jim's talking about. It's just, I tweeted out, we're tweeting live some of these comments, and I'm thinking to myself as I'm writing this stuff down, I can't even believe I'm tweeting this out or writing this down. These are pretty interesting statements. Okay, so on to our questions. We've got about 12 minutes left, so we're going to do our best. We have a great number of questions that have come in as usual. And some of these are really good questions. We're not going to be able to answer all of them, but we will do our best to answer some of them. So one of them that's come in that looks like a really good one is coming from Steve M. And his question is there a scenario where the Fed would be forced to raise rates regardless of the state of the economy?
There is. I think it's unlikely. It's not in my forecast, but people have talked about it, and it could happen. I mean, just because I have a forecast doesn't mean that's any guarantee that's how things are going to play out. They could. Here's why they would do it. And I find the whole debate about raising rates just a little sterile because the quality of the analysis is poor. A lot of people say, well, it's been a long time, so you ought to raise rates. That's not analysis. That's a claim. That's a declaration. But what kind of analysis is that? That's like saying, I'm tired of playing Russian roulette. I think I'll blow my brains out and get it over with. I mean, that's not a reason to raise rates just because it's been a long time. As I said, they should have raised rates in 2010. And I said that at the time. I did an interview on CNBC in August 2009, and I said, Joe Kiernan turned to me and said, what should the Fed do now? This was August 2009. I said, they should raise rates 25 basis points. There's no global financial panic. There's plenty of liquidity. Now, it's true that unemployment was still 10% and the economy was still recovering. That's all true, but so what? I mean, what does the Fed have to do? This idea that they can create jobs is nonsense. The Fed doesn't create jobs, but they didn't, and not that they were listening to me in particular, but that was the time to raise rates. They failed. So just because they failed to do the right thing then doesn't mean they should do the wrong thing today. Today you should be easing because the economy is slowing down. The IMF just told us that. There's plenty of evidence. The data is coming in. I'm used to seeing data that's mixed, some bad data and good, and I try to parse it and look for trends. And on balance, I've been a little bit maybe more than a little bit bearish on the economy. But now I don't see any good data. I don't see the other side of the argument. All the data, exports, deflation, labor force participation, wage growth, manufacturing surveys, service surveys, just everywhere you look, beige book, it's all trending down. So I don't see the case for raising rates. But if there is a case, it would be because they're worried about bubbles. They say, okay, we need to let the air out of these bubbles because if we don't, these bubbles are going to burst and it's going to be a lot worse. And whatever damage we cause by raising rates at the worst possible time will not be as bad as letting the bubbles persist and having those things blow up. That would be the argument. So there's one problem with the argument. I cannot think of a single case where the Fed actually did that, where they actually correctly identified a bubble and tried to finesse the air out of the balloon. They didn't do it in 94 in Mexico. They did not do it in 97, 98 in emerging markets. They did not do it in 2000 with the tech bubble. And they did not do it in 2007 with the mortgage crisis. So they have no history of, first of all, correctly identifying bubbles, and secondly, knowing how to let the air out before they explode. And it's also a pretty unappetizing scenario. So the economy is getting weak, but you're going to be the one to raise rates and make it weaker. They're going to be driving tractors up the steps of the Fed, which they did in 1980, by the way. They had a tractor march because the farmers were complaining about the back-to-back recession, and some farmers tried to drive their tractors up the steps of the Fed. You'll have that, if not, torches and pitchforks on Constitution Avenue. So could it happen? Yes. What would the argument be? The argument would be that we know we're doing damage, but it'll be less damage than letting the bubbles come. We're going to try to pop the bubbles. But I find it extremely unlikely. There's just no history of it, no policy in an election year in 2016 they're going to do that. I don't think so. Now, the other scenario where they raise rates would be if the economy actually got better. I mean, I agree with that. If inflation gets up to 1.8% and growth gets up to 2.3% and unemployment comes down for the right reason as opposed to the wrong reason and all those trends are moving Janet Yellen's way, then they would raise rates. I would be the first one to say so. They'll raise rates within 30 days. But that's not what the data says. I mean, that is not how the data is coming out. The data are all far from Yellen's goals and moving in the wrong direction. So if you get real growth, moving towards her goals, she'll raise rates. That would come as no surprise. But I don't see it in the data. And to raise rates in a weak economy, the only reason would be to pop bubbles, and there's no history of that, so I don't expect it.
Yeah, and that makes a great deal of sense. Moving on to the next question, I think some people wonder, as far as the assets of the IMF, I think people know that the IMF does own gold as an asset. I was recently reading a report by the IMF that shows gold and gold bullion actually on this chart. It's listed higher than SDRs and higher than the currencies of sovereigns. I don't know if they actually emphasize it that way internally or if that actually means anything, but it is important, obviously, as a reserve asset according to the IMF. So the question here is coming from Jim H., and he wants to know, does the IMF simply print SDRs and then buy their gold? And if they're just printing SDRs, isn't that inflationary by definition?
Great question. The answer is that the IMF has about 3,000 tons of gold, a little bit less, 2,900 some. But, for a round number, 3,000 is a good approximation. They have 3,000 tons of gold. That's a lot of gold. That's the third largest stash of gold of any individual country. The United States has a little over 8,000 tons. Germany has a little over 3,000 tons. And then the IMF comes in third at 3,000 tons. Now, having said that, that's the World Gold Council's data. That's not how I analyze it. What I do, I take all the members of the Eurozone, the single currency of the euro. There are 19 countries behind the euro. I combine all their golds because that's the amount of gold available to back up the single currency. That number is over 10,000 tons. So the 19 members of the Eurozone have 10,000 tons. So I count them as number one. I count the U.S. as number two with 8,000 tons. And then China, officially, they're just under 1,700 tons, but there's very good evidence that they actually have 4,000 tons, perhaps more. Using that evidence, I would give the Chinese credit for 4,000 tons. So I'd make them number three, and then the IMF is number four. But it's a lot more than the next closest guy. I mean, the next closest guy, you've got Switzerland and Russia with just over 1,000, then you drop off to Japan, around 700, Netherlands 600. So it really goes down fast from there. And then, interestingly, Greece has 100 tons, although it's in hock to the European Central Bank. So the IMF is one of the largest gold hoards in the world. They got it from their members. When you join the IMF, it's like joining a club, right? If you join a club, you have to pay dues to the club, and there's usually a pretty high initiation fee, and then you pay monthly dues. Well, going back to the 1940s, 1950s, when you joined the IMF, you had to buy in. You had to, like a poker game, you had to put up some chips. And at the time, you put those chips up in gold, partly. You could give them currencies as well, but mostly you gave them gold. So that's where the IMF got their gold. So this goes all the way back 70 years to 1944. Now, this is not true today, by the way. If a new country joined the IMF, they don't make you give them gold. You can actually give them your local currency. It's pretty cheesy, but at the time you had to put up some gold. Now, the IMF used to have more gold. The IMF sold 700 tons of gold between 1975 and 1980 in that 5-year period as part of a secret plan. Again, when I say secret, these were classified documents at the time. They've been declassified, so we have scholars have access to them. But President Ford, Henry Kissinger, and the IMF did a secret dumping plan between 1975 and 1980, and they dumped 1,700 tons of gold on the world markets, 1,000 from the U.S., 700 from the IMF. So the IMF actually used to have more gold than they do. They gave 700 tons back, but they used to have about 4,500 tons. Dumped 700, returned 700 to the members. It was about 5,000 tons. The IMF also sold 400 tons of gold in 2010. It was part of a gold dumping exercise. That was sold to Mauritius, India, and Sri Lanka. That accounts for 200 tons. The buyer of the other 200 tons is a secret. Don't know who it is. I'm pretty sure it was China, but I can't prove that, so I'll label that as speculation. But so even as recently as 2010, the IMF was dumping gold to suppress the gold price. The problem is that eventually when you're dumping gold, you run out of it. So no, they got their gold the old-fashioned way. People paid in to get stock in the IMF. As far as SDRs are concerned, they do print them and hand them out. There's nothing more to it than that. It's just printed money. They have not been using it to buy gold. It would be interesting if they did. That would sort of be a gold-backed SDR in the making, which is one solution to the global liquidity problem. The only problem is to make that work, you'd have to have the price of gold around $10,000 an ounce. And I think we'll get there as the situation deteriorates. But you can't print money and buy gold or go back to a global gold standard unless you're willing to raise the price of gold significantly in order to have enough liquidity for world finance. And I've done that analysis, and the answer is it comes out to about 10,000 tons of gold, possibly higher. I mean, you could get numbers, depending on assumptions you want to make, as high as $44,000 an ounce, but I'll stick with $10,000 an ounce for now. The IMF does have a lot of gold. They've stopped dumping it. I think they're going to sit tight with what they have. SDRs are printed and handed out. They are not using SDRs to buy gold, but they could, and that would be a radical change in the so-called rules of the game.
Okay, excellent. And I'm going to go with one more question here. The reason because we're pretty tight on time, but this question is something that I've actually thought about as well many times, and I think it's important for people to consider. This question is coming from Roberto C., and his question is, what's the best product to buy gold and have access to your money if you want to sell when liquidity becomes an issue?
Well, there are a number of funds that sort of tailor their product to exactly what Roberto is asking. Of course, I'm on the board of advisors of Physical Gold Fund, so that would be my first choice. But in fairness to listeners, there are a couple other programs out there. But here are the key things: you want physical bullion. You do not want ETFs, you do not want COMEX futures, you do not want unallocated gold forwards from London Bullion Market Association banks, and you certainly don't want any, kind of cheesy dealer over-the-counter contracts. You don't want paper gold. You want physical gold. So that's number one. Number two, you want it in non-bank storage. People don't want to put any significant amount of gold in their homes. Obviously, there's security there, so they are looking for storage, for vaults. You want vaults that are reputable, that are insured, that are bonded, that have been around for a while. Physical Gold Fund, kind of qualifies in all those respects. The Physical Gold Fund vaults, I've actually visited them. It was a memorable visit, but part of my due diligence, but also getting acquainted with the team at the Physical Gold Fund, was to go visit the vault in Switzerland. And sure enough, there was the gold. We went into the vault. We had auditors, we had guards. It wasn't just Physical Gold Fund people. There were a lot of third parties with us, and it brought it up in a forklift and opened the seals and opened the lid. It's almost like Raiders of the Lost Ark, but there was the gold, and all the serial numbers checked out. So that's a very, very first class operation. But the Physical Gold Fund, again, there are others out there. In fairness, if you buy one of their units, and that money goes straight to the physical gold. There's no other, they're not hedging with futures or anything like that. If you want your gold, you call them up and say, I'd like to take delivery. There's shipping costs. It could take a day or two to actually show up on your doorstep, but they'll deliver it to your house. And so, considering that you could be living in a world where the banks are closed, the ATMs have been reprogrammed to only give you $300 a day for gas and groceries. Stock exchange is closed. The money market funds are closed. You could be living in that world, and the Physical Gold Fund is a place where you can call up and they'll ship the gold to your house. So that's has a lot to commend it.
Okay, very good. With that, we've pretty much used our allotted time. Jim, thank you very much, as always. And John, I'm going to turn it back over to you.
Thank you, Alex. And thank you, Jim Rickards. Always a pleasure and an education having you with us. And most of all,
John.
Thank you to our listeners for spending time with us today. Of course, you can also follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.